For our COBT friends, it's Maynard, Mike, and Arjun here with something super topical that we've been talking about for a long time and that we find more and more of us are wondering about. The topic is international E&P, but more importantly, the friends are Bob Maguire and Parminder Singh from Carlyle's International Energy Group. Bob joined in 2014. He's the co-head of the effort. Par joined in 2008 to Carlyle. In 2014, he started working with Bob in the international effort. They've done quite a number of investments internationally. They'll tell us all about it. They manage two funds, which total almost $5 billion. They were some of the first people to start talking about we should be investing in international E&P. And so we're just delighted to have you guys. They're good friends. They're really interesting. And this is a topic that we've been wanting to talk about. So welcome.
Thank you. Thanks.
All right, Mike. Well, before we go on a tour of the world and a tour of energy, what would you tell us today about what's happening?
Yeah, today was an interesting day. I mean, it was a down day for the market. The Dow was down about 150 points. S&P was down about 0.5%. And that was really this morning, Chinese export-import data came out for July, and it was pretty weak. So obviously that sold off equities and bonds and also crude oil. And so, you know, that kind of influenced the market. I think what we're going to see this week is the markets are really going to be focused on Thursday CPI data and Friday's PPI data to kind of get an idea where the Fed's going to be going here. 10-year bonds are a little bit above 4%, so that's going to be a really important thing for the market. I'd say the second thing I'd say is, you know, when we looked at today on the data that was out, crude oil was weak. It was started at trading today around 82, went below 80 on that Chinese demand, and then it basically, you know, recovered to get up to around $83 a barrel. And so the reason I mention that is that, you know, a month ago, 2 months ago, if that data would have come out, the market would not have come back. Crude would have stayed down. And so the tone of the market has really changed here. And the reason why is the market is physically more tight, right? I mean, time spreads are in backwardation. And so that's a really, really good setup. I'd say from the standpoint of the market over the next couple of weeks, we're essentially through earnings season. So most of the market moves, volatility over the next, you know, couple of weeks and months is just going to be economic data. So, you know, obviously the CPI and PPI is going to be really important. The last thing I'd finish off with is, yeah, earnings season is pretty much behind in energy, and maybe 3 or 4 themes that came out of that. You know, really on the E&P side, the major thing we saw was just well productivity. Every call, most people were raising production for Q2, and you know, a little bit for the second half of the year, they're raising production. They're just getting better well productivity, and it's gone a lot longer and a lot further than we thought, and so that's a good thing. The other thing that's good about that is that CapEx dollars are not going up. They're staying the same, or even in some cases going down. And so you got better well productivity and essentially more free cash flow. That's number one. Number two, from an oil service standpoint, you were talking about deflation next year. Remember, like, you know, last couple of years we've just been talking about inflation. We're probably going to be looking at deflation. Most of the companies didn't really want to get over their skis and say what CapEx is going to look like for 2024. It's too early. But it seems like it's going to be deflation of mid-single digits. I'd say from an offshore oil standpoint, driller standpoint, I mean, just a lot of momentum there. Day rates are going to be going to record levels. Contract length is extending quite substantially. And so that market's going to be really, really tight. If you're an offshore guy, international guy, you're going to be looking at inflation, not deflation. And so the last thing we would really talk about is the refiners also reported as well. The good thing we saw there was, you know, gasoline demand looked okay, jet demand looked fantastic, and diesel was kind of subpar. And so what we're seeing there is mid-cycle, you know, we have cracks right now above mid-cycle, and so that's a good thing. So earnings estimates are going up, free cash flow is going to go up there. We're going to have heavy refinery maintenance in the second half of this year, so it looks like a pretty good setup for the refiners. So just kind of a little bit of what's happened in Q2, but you know, setup for energy right now looks pretty good.
I was thinking in your lead-in on the China thing, it seems like it's been a long time since we got any good China economic data. I mean, we had the stimulus spending, but it just doesn't seem like we've had any good news in a while.
Yeah, you know, and funny thing about it, like I said, a month ago or 2 months ago, that would have come out. It would have really hit the market. But right now, the market has shifted from a demand problem to we do not have enough supply because OPEC is taking those barrels off. So you really have a tight physical market right now. And so, yeah, that temporarily hits crude, but, you know, it really looks like a positive constructive setup right now.
Arjun, anything you'd throw in the hat before we turn to our friends?
Maynard, I thought I'd focus my remarks maybe in the spirit of our guest that we'll be speaking with today, which is, I go back to the start of my career, Maynard, in the early 90s, and it was maybe 5 or 10 years into the bust from the 70s boom and the fall off in the 80s. And everyone knew at that time the US was mature and you had to go overseas. And it wasn't just, this is before the super majors, it was the big international integrators, as we called them, but all the domestic oils and a whole bunch of E&Ps had global operations. Some of it was exploration, some of it was production and so forth. And of course, from shale gas to then shale oil in the 2010s, the business went the entire other direction. And every company, including the big guys, which ultimately lagged but caught up, became shale, and more shale. And it's been 70% of global oil supply growth over the past 10 plus years. And I think we're getting to the point, as we've talked about, where we're seeing some signs that maybe the best days of growth are behind us in shale, or at least we're going to need some diversification out there. Yet you're down to really just the super majors, maybe some non-US independents, but the market's really forgotten about international, how to do it, where you'd want to go. And I think we're in the early stages of some of that sentiment starting to change, but it's changing or should change or will change at a time when a lot of companies have lost that global skill set. Exploration is not what it used to be, nor is just simply that idea of taking risk and going overseas. And I think, just as a segue to our guests, I'm excited to have them here because I think they've been early into this trend, and I know they've had some success already. But I think this conversation of how do you go overseas, how do you think about taking risks, and what are the different ways to do it, I think some of the themes that I'm looking forward to following up with in this conversation.
No, that's great. Well, Bob and Par, Arjun mentioned it. I think that's the thing that jumps out at us who, we've been so absorbed in the shale experience in the U.S., but you guys were leaning into international E&P in 2014. So kind of the one of the initial first peaks of shale before it went on to peak again and again. But Bob, what led you to
Arjun,
go off on that?
To your point, I mean, yes, I started in the private equity side in 2014, but my experience of the industry starts in the mid-'80s, and my entire career has been outside the U.S. So the difference, I think, then and now is then we had these new basins opening. So you had the North Sea, which was relatively immature in the UK and Norway as well. And so there was a lot of excitement, both from the majors and the independents, moving to the North Sea, UK and Norway. And that was a big sort of focus at the time. I think the difference now is there isn't an equivalent. There isn't an equivalent new basin that's opened up. So people are looking at the traditional basins. We are, for instance, in one of our portfolio companies, we were in the UK, Norway, Holland, Germany, but also Algeria, Egypt, Indonesia, and a little bit Australia. But none of those was a sort of primary focus. I guess Norway was the majority of the business, but there wasn't one area that we were focusing on. And we were comfortable to do that, I think, because we had this history outside the U.S., this network outside the U.S., and we were able to sort of, I think, get our head around it, and more importantly, conviction around it, maybe sooner or more easily than others would.
What was the original premise? Because I remember when you announced the effort.
Well, the original premise was based on the observation that 85% of private equity capital that goes into energy in the U.S. or Canada. So the entire rest of the world was relatively, under not exploited, but underexplored, undercompeted by private equity, and it seemed wide open to us. That was true then, and it's become, just as true now, I think, in terms of private equity.
So maybe that's one question. Let's go there on capital. From 2014 through to today, what would you observe about other capital showing up and wanting to do things in some of these places, Latin America, West Africa, the North Sea, et cetera?
Well, I'll just make one observation. We had one of our portfolio companies, Neptune Energy. We sold or announced the sale, the agreement to sell to Eni last month. And what was interesting about that deal was that it was, first of all, the largest cash deal in the industry outside the US in 10 years. But more importantly, from my point of view, it was a strategic buyer, E&I, buying from a financial owner, not the other way around. And that indicated that, you know, the sort of capital strike that the industry had been on previously, for whatever reason, is now sort of relenting a bit. And so the IOCs, the bigger companies like E&I, can come back into the market where they see an attractive portfolio. It was interesting that one of the things that they pointed to as an attraction of our portfolio was the relatively low carbon intensity. So in our portfolio, the carbon intensity was 6 kilos per barrel versus E&I's average of somewhere between 25 and 30. So by doing this deal, they were able to be accretive to their carbon targets by as much as 30%. So I think that was an interesting new development. Permission to do it, permission to go back into upstream acquisition, but largely because, or partly because, they have this argument around carbon intensity.
Par, would you mind maybe talk a little bit about that deal? Because it was fascinating. You were able to, you know, what we know here is that the pressure on the big European integrateds around the transition is just more intense, both from a social standpoint and also from an investor standpoint. So here you kind of got the business because a company decided to get out of fossil fuels, and then you exited the business because it was okay for a big continental player to come back in. Would you just maybe talk about those dynamics and also just the pricing or the value, just what you saw in that period?
Yeah, sure, Maynard. So the background to the Neptune transaction is, you know, we'd set up the fund in 2014. We, a year later, set up a joint venture with Sam Laidlaw and CVC to explore for a large acquisition in the international upstream space. We screened a number of deals in the market, and we sort of, went around describing the product to sellers, and they kind of scratched their heads a little bit because they hadn't seen something like this before. And we said, we're looking to buy, a $5 billion portfolio of international upstream assets. What do you have? We talked to the banks about that. They didn't know kind of how that might work. We ultimately were able to identify the target acquisition in the NG E&P portfolio, which was a really nice, diversified portfolio, producing with cash flow, well invested by NG, 3 very large multi-billion-dollar gas developments that were just coming online, but a seller that was going a very different direction. So NG was doubling down on the electron side of things, really going green in their transition efforts, and we're looking to exit this business.
Can I just ask you one question, Park? Because
Yeah.
I'm sort of replaying this and thinking about it. When you guys first started, like 14, 15, 16, wouldn't you have still run into like Chinese money trying to buy these assets? Somewhere in there, the Chinese appetite for international assets faded.
Remember, our partner in Neptune was actually CIC.
Okay.
So they were already in the business. They owned 30% at the time. They rolled 30% in and added another 19%. So they owned 49% of the business, but looked to us as the industry experts to manage it and run it, which we did.
Yeah,
they were there.
So we carved out that division entirely. CIC, the Chinese, rolled over their stake, increased their ownership because they bought into the thesis that we were putting forth on, just classic operational value creation. Running this like an E&P business. Our CEO at the time asked for a daily production report after closing, and he wasn't able to pull that because it just wasn't tracked. And so it was that kind of stuff that we implemented, running it like an E&P business with the right KPIs. And interestingly, the market turned to a place where a European IOC could make a multi-billion-dollar acquisition in the space.
And can you talk about, so you make this really large acquisition, you held it for almost 6 years or so. Your idea on how you would be exiting the asset had to be changing we all went through so many changes in there, but can you talk about how because I think your strategy was a little more buy and hold or buy and cash flow it out, or You should talk about it.
Well, actually, I mean, we set it up initially with this eye toward potentially an IPO, because Bob and the team had observed that over the last several decades, there was a gap for a mid-cap independent E&P in the international markets. And those businesses had existed in the past, and they were good propositions for shareholders. And there was a big gap post BG, particularly for that kind of business. So that's kind of how we were thinking about it on the way in, and that obviously evolved as the world changed post the war.
Do you remember, Arjun, in the 90s, there were probably 20 independents traded in the market in London, and gradually they all disappeared until eventually the last independent to go, if you could call it that, was BG. And so there was this gap in the market that we said, well, that is a vacuum that you could put somebody into. So that was the original plan. But then Harbor came along, Aker BP came along. You had these various other companies that sort of took that ahead of us. And if you can find a strategic buyer, I would rather do that all day.
So would you mind sharing? So then you went through the process, you sold Neptune, E&I buys it. They say it's carbon footprint accretive. Was that well received? Do you think we'll see more of that type of thing? Can the Europeans start buying more oil and gas assets, or what do you think?
We're seeing that in the market ourselves. I mean, the flip side of this, if you have a market into which you can sell assets like Neptune, it's more difficult then to be a buyer in that market. And we see that in a couple of processes that we're involved in now, where the majors are back again. We made a bid the other day on something which last year would have got us into the second round. This year we weren't even close because we're competing with IOCs. So they are back. And I think, if Neptune was an early example, I think there's going to be more of that coming.
So as you guys, I think, some of our conversations will talk about the world will need more oil and gas. The U.S. at some level will slow down or be less over the next 5-10 years. And then the question becomes, so where do you go internationally? What are some good places to go? You guys have been thinking about this. You got your war room. You don't have to tell us all your secrets, but how would you advise people who are thinking about, hey, I should look at the international again? Which countries? How should I sort them? Like, what's your advice to someone who's beginning to think about this again?
Yeah, I mean, from our experience, we've been very focused in areas that we know and understand. So, the Neptune portfolio was diversified, which was great, but these were jurisdictions where the team had done business before. We bought a business from Shell, an upstream oil production business in Gabon, which for many is, like, where is that on the map kind of thing. For us, we had an operator in our team who had managed, upstream assets in Gabon. Our fund head at the time, had invested in the country, and so we had an edge there. And so I think it is important to have, that connectivity to create conviction. Otherwise, it can be quite challenging. Diversification helps, but having that connectivity is important. Now, in our conversations with folks around here in Houston, while we've been here, I mean, it is clear that there is more appetite to go abroad. And we're hearing, kind of a similar message in that folks are sticking to, places where, they currently operate, which is very sensible. We've been.
So sorry, Par. What you're kind of hearing is, if I am somewhere international, I might do some more in that area. Right. That makes sense. Yeah.
Right. Exactly. And that may lead to, more consolidation in certain countries, certain basins. But that will probably create some opportunity for, bits that are non-core to those businesses. And that's where, someone like we can come in and sort of, help clean that up.
But that example in Central Africa, in Gabon, was a company called Asala, is what we called it after we bought it from Shell. But it was a classic onshore, business, it's your business, We bought it, I think we bought 80 million barrels. We've produced 90 billion barrels in our ownership period. We are left with 125 million 2C, and we just made a 50 million barrel discovery. So it's just a classic case of where you take out costs, you spend capital, you increase production, you increase reserve life. We took reserve life from 5 to 8 years, and our ownership period is pretty basic, sort of block and tackling kind of stuff. But you can do that if you can see it in advance. If you have the conviction because you've been there before, there's no real mystery to it. But I'd say if there is an advantage that people have, it's that non-replicable experience, right? So we happen to have an experience in Gabon that others didn't have. And as a result, we were able to develop the conviction that allowed us to pay the price that looked big at the time, but it worked out.
You're both referencing it, the importance of your team, your team's experience, and who you're backing, and what your previous understanding is. Are there, and Arjun referenced this, is it like, where are you finding people these days who understand West Africa, who understand Latin America? What's the supply of people with experience and ideas and desire to go back?
Well, it isn't, it isn't a very deep market for.
It isn't a deep for people, you mean?
Well, for private equity style transactions in energy in international markets, I contrast that with the U.S. model, where there are many management teams who've made some very successful acquisitions, created a lot of value across cycles. In international markets, there's kind of a handful of businesses, many of which are businesses that we've built over the last 5 or 10 years. And so, oftentimes when we look at an asset, we sort of start the analysis ourselves and kind of work through the diligence ourselves and execute. We do have, operational folks in the team and around the team that help us work through that process. And when it comes time to close an acquisition, we'll bring in the right management team for that asset. We've got folks in the bullpen today, from Asala and Neptune and other businesses in the portfolio, who we'll go to again for support. Otherwise, it's really kind of managed through the networks of the team. But it is a hot commodity, that talent.
But it's an interesting reflection that I've thought about this point I made in the beginning. What does it mean that 85% of private equity capital has gone into North America and the rest of the world is uncompeted? It means, yes, there's less competition, but how does that affect us? Because the industry is there. So we're sort of not competing with financial buyers, but what is the difference? Well, I think the big difference is that in North America, the ability to give these management teams equity is so well known, and there's so many people offering them equity, that the management teams become a much scarcer commodity. Where for us, because it's relatively unknown, you can go to most of these people who are in operating jobs and offer them an equity position or equity incentive that they couldn't get and aren't getting anyplace else. So that is one of the advantages about being one of the only financial players. We can do that. And if we look at an acquisition, we can usually find the team we need or the team we want with relative confidence.
Are you sensing, or I think this is what we have thought may be happening, is that various countries around the world are looking up and saying, I would like to have more domestic production. I probably need to improve the terms on which someone can enter my country. And so we have been saying or feeling or thinking or hoping that some countries are saying, I'm going to improve my terms. Is that going on? Are there any countries you'd point to? What's happening?
It's a little more subtle than that. I start with Norway. Norway had a very thoughtful sort of approach to developing the NCS. And at some stage, they said, we need to encourage what they call plurality on the NCS. We need to encourage different kinds of companies to come because it's good for competition. So yes, you want the IOCs. Yes, you want NOCs, but we also want independents. And now they're getting to, we also think there's a value to having financial sponsors because we bring something different. And the combination of all of that sort of prolongs the life, prolongs the competition, prolongs the sort of, kind of energy within this NCS. So I see that happening in other countries. For instance, Malaysia now, I think, has an interest in doing the same thing, developing a plurality in the Malaysian sort of system that isn't there now, because it's good for the future of the industry. Now, getting private equity over that hump is a big thing, right? Because if you go to the Ministry of Energy in Norway and tell them, we want to come in as a private equity player, Norway is so cautious about how it develops the NCS that the initial reaction was, wait a minute, we've heard about you guys. But because we were able to sort of break through that with Neptune, delivered, I think, a really good project in Norway, we've developed a sort of reputation, I think, which has helped the other players there as well. But, I think that's fairly sort of high policy level stuff. But that's how I see it developing.
Yeah, we talked in our introduction a little bit about deep water rates, stuff of that nature. And I just wonder how, it feels like you've been sort of in a deflationary environment for sort of international offshore pricing over the last 4 or 5 years, but it looks like the next 4 or 5 years, they're following the mode of the North American guys where, we'll idle capacity, we'll get pricing, we want term length, stuff of that nature. How do you think about how that's changing how you look at the business over the next, say, 5 or 10 years? And the reason I say that is if you go on a Schlumberger call or a Transocean call, the amount of countries that are actually doing stuff like exploration-wise and development-wise is just, it boggles the mind. It's just, they're all over the place. It just seems that there's going to be a fight for equipment here, over the next, and even for people over the next 4 or 5 years. How do you think about that when you're approaching your business, or is it maybe the right time to be thinking about getting out of the business until that kind of calms down?
No, I think, we've seen that that inflation in services across our international portfolio, really. It's just the reality of the supply and demand of those services, particularly on the more asset-heavy stuff, I'd say. And, a lot of that is just natural cycle, right? Where, that after a period like the past 5 or 10 years, it's natural for this kind of tightness to emerge. But it's been a bit exaggerated because, a lot of folks, 3, 4 years ago would say, you're never going to need a deep water rig again, right? That was almost a consensus view in many places. So, that is there. We price it into acquisitions. So when we look at, what the next 4 to 5 years might look like from a cash flow perspective, it's all kind of baked in. Fortunately for the upstream operator, it tends to move with the oil price. And so there's a bit of a natural hedge to it. There's some lags, of course, but there is a nice hedge. But yeah, we're certainly seeing it.
But we also, in terms of asset selection, we're looking for stuff that's relatively short cycle, where your CapEx is more discretionary, so you can react to changes in commodity price, you can react to changes in supply costs or service costs. And if you miss that window, it's not critical to an overall CapEx program. So that has worked for us. Now, if we're not taking on some huge sort of single project development, that's how we manage it.
How do you think it also changes the dynamic for private equity in the business and maybe even smaller cap E&Ps? It seems like if the majors are getting back in, some countries are getting back in there, that's going to squeeze those guys out. Is that how we look at the environment over the next couple of years? That if we look at it 3 or 4 years from now, there's going to be half of those smaller guys are going to be gone just because they can't compete?
I definitely believe that it's safer to be big than small. If you have these single point vulnerabilities and something goes wrong, the thing that goes wrong usually cascades, and it's a lot worse than you thought at the beginning because you have no way out of it. You have no other lever to pull. You have no other way to win. So again, it's asset selection for us. I think that's one of the things why it's so hard to deploy capital there, because you're looking for exactly the right thing for what we do. And that has to be that combination of short cycle, conviction, discretionary CapEx. There's a lot of things that have to work.
Yeah,
right.
I would just emphasize the going big point, because the value of diversification across basins and fields it's super, super important, because you just create idiosyncratic risk across many different slices of your asset base in a market where you're exposed to a lot of beta in the oil price. So that's a great way to insulate yourself, and it's appropriate for. It's great for financing purposes. It's great for cash flow.
But it's also why, in the beginning, for instance, with Neptune, we wanted to get a recognized industry player like Sam Laidlaw to lead the effort. We wanted to make sure we had sufficient capital, which is why we worked together with CVC and ultimately CIC. We wanted to be able to tell the market that we were looking at a time when such financial players as there were looking in the sort of 500 million sort of area for assets. And we wanted to be able to say we're looking for 5 billion, because you can get up, that scramble up as high as you can go. The competition gets rarer, gets more sort of specialized. And that was what we wanted to signal when we went into Neptune. And that's how that played out for that reason.
Maybe I'll jump in here. I really love the Shell Gabon example. I mean, it's just such a classic sort of acquisition and exploitation strategy. I mean, I can still hear sort of Ray Plank and Steve Ferris talking about the 40s field when they went in there, and it's domestic, but even Dr. Irani and Steve Chasen, when they first bought Altura, saying we're going to produce, 100 million barrels over 10 years, and 10 years from now, we'll still have 100 million barrels, and who knows what oil will do. It's a classic E&P skill set, yet it's gone away because of shale. And I think the question is for, when I'm thinking about some of the folks who will listen to this, who clearly the majors and the big guys can still do this stuff, but maybe for some of the mid or larger independents who may become very US focused, I find the private equity approach very interesting and very appealing. You all have ideas, you've got a financial expertise, you have capital, but ultimately you partner with best-in-class management teams that know that area, your example in Shell Gabon and other assets. When I think about traditional companies, they tend to rely on the existing management team, and maybe they hire one or two people, but there's this idea that management team has to do everything and know everything. And that idea of partnering with folks who might know a specific area, of having different structures, the business is very different now. No one cares about production growth like they used to. It is about, what is my return on capital? What is my dividend? What is the cash I'm returning to shareholders? It's honestly not that different than, I would argue, having a private equity or financial mindset. And I'm just wondering, do you see hope or opportunity, or would you advise, if you were in our seats, some of these companies to start thinking about it differently? They're not going to be Carlyle. They don't have your expertise and firm structure and so forth. But is it possible for these E&Ps to have a different mindset about how to go back overseas and to do exactly that kind of asset? There's 90 million barrels, we produced 85, and there's still 150 left. That is such a classic example.
Yeah, I mean, I distinguish, because it's important when we talk about this, for instance, buying from Shell. It isn't that Shell has done a bad job with Gabon. It's that Shell, given the way Shell is, and the structures and processes you need to put in place to run a global business like that, is probably not appropriate for a later life asset like Gabon. Whereas a private equity buyer can be, it's not a better owner, it's a more attentive owner, right? The Shell shareholders want Shell to do exactly what they've done. Work on the big new projects. As soon as your old projects become an annuity, sell them to somebody who can make more out of them. That's what they did. It's not just Shell, that's just the food chain and the life cycle in the industry. So that's that. So it's more important to make sure when you buy an asset, I think, that the broader corporate sort of requirements, the processes that you've embedded for the way you think you need to manage a multinational business, don't get in the way of the local operations. I think that's the lesson I would learn.
In the same way that, this is more for the larger companies, as they've thought about energy transition, at least a number of them said, hey, we're not going to be XYZ experts in all these different technologies. We'll have a venture capital fund that we'll allocate to people who know what they're doing. I do wonder if that kind of business model might not make sense for, I'm not talking about Shell or Exxon or the big guys, but some of these independents that I think are going to have to look more broad-based. And more importantly, there are opportunities in the rest of the world.
So they could be financial/expertise partners to a lead group like yourself or one of your teams doing things in some of these places.
Well, I think there's a new sort of filter that's overlaid this now as well, which is the energy transition ESG concerns. So I think if you're one of these guys who wants to come in, you now have to come in with a partner that the market is comfortable is actually going to make a difference. in owning these assets. They are going to decarbonize. They are going to lessen the emissions intensity, because otherwise you're just, either selling your carbon to somebody else who's going to mismanagement, and so you can't get away with that anymore, or you don't want to buy into it because your partner becomes a liability or an embarrassment under that lens. So it's important to have a track record, I think, of what we have been able to do in Colombia, in Gabon, in Neste, reduce carbon intensity and make a difference.
See, it's really interesting because in your E&I example, they bought something that lowered their CO2 per barrel, and that was accretive and good, and now E&I is a better company. But in what you just referenced, Bob, is if some companies take over something that has high carbon intensity, and they say, okay, it's dilutive day one, but I'm going to go in with my expertise and I'm going to do great things by this asset, and I'm going to bring that down. That's ironically a better story than I bought something that's accretive. I bought something that's dilutive, but I'm going to make it better. That's it.
Correct, which is why I was so excited about E&I saying what they said, because it's another source of value creation for people like us, right? If you can buy an asset like that, reduce the intensity, and you enhance the value, you can then sell it to the next guy.
So can I ask you about that? As you've looked at assets, and Par, I think you were with us this summer and we talked about a couple of these examples. What types of approaches and opportunities are you seeing to, quote, lower the impact of the assets once you take them over? Because I think some of it is nuts and bolts and some of it is, technology. Like, talk to us about reducing carbon intensity in your portfolio.
It's really interesting to see how this space has evolved over the last couple of years. I mean, this was not a key value creation lever for us when we underwrote the Neptune and Asala deals 5 years ago. But when we bought our business in Colombia from Oxy during COVID, we started to work this into the plan. And our first board meeting after closing, we asked the management team, what they could do about the carbon footprint, which was significantly higher than the peers, and was something that had flagged up in our diligence. They came back with a few ideas. We pushed them a little bit harder, and ultimately they said, look, if we can plug into the grid. They're burning crude oil in the fields today. If we can plug into the grid, which is predominantly hydro, we might be able to cut emissions by half. And so
they were burning oil in the field just for
installations,
electricity.
For power,
for electricity, 3,000 barrels a day. And we said, well, gosh, if we can produce that, and we can clean up the emissions story, that could be really interesting. It turned out, the roadblock was, the conventional thinking was, sure the grid is there, but it goes down a dozen times during the day, and that's just going to be unpredictable. So we asked the team to kind of push on that, and what's the analysis behind that? And it turned out it would go down, but it would go down for very short periods of time, which with a $1 million battery you could kind of keep it continuous. And so the team went off and got the permitting done, and put the battery on site, and we've reduced emissions by 40% in the first 2 years of ownership, and we'll be cutting emissions by half by the end of this year. And that was not something we underwrote, but it was something that we challenged the team on just after closing, and it was really interesting to see how that transpired. Just from creative thinking. That then got the team kind of really excited about this, and they started, coming up with sort of additional ideas. One of the guys said this is a pretty mature oil field, produces about 1 million barrels a day of water, which comes out at 100 degrees Celsius. And so, one of our engineers said, that's 10 megawatts of geothermal. Let's go after that. And so, the innovation engine gets going, and the team got really excited about that.
So one thing I think we're always, when we talk about the developing world, we're always frustrated that not enough emphasis is put on just getting more energy and more power into the developing world, which will lift incomes and improve the environment, and we're too often focusing on carbon emissions before we focus on just their way of life and their economic development. You guys see all that, right? And so what would you tell us about the ability to get financing, the ability to get pipelines approved? What is, when you think about the developing world and the tone and the form and the substance around improving energy in the developing world. What are you seeing good and bad in all of that?
The bad thing is the discordance between, the developed world and the developing world. I mean, the spectacle of Europe lecturing Uganda on the construction of their pipeline from the Albertine Basin. I mean, it's just obviously an outrageous position for people to be taking. I mean, criticizing the developing world for subsidizing fossil fuels, right after they spent a year subsidizing the cost of gas as a result of the Ukraine war in Europe, right? Or running up the cost of LNG so that you take it back from the developing world and now criticize the developing world for having to burn coal. I mean, the only encouraging thing I see is that there is gradually a kind of recognition that it's not as simple as we thought. That this is a sort of, there's a lot of different things that have to be reconciled here. And particularly if you have a transition that is entirely policy driven, which this has to be, because there's no commercial driver, there's no technological driver, it has to be policy driven. And reconciling the policy of Europe to Southeast Asia, to Africa, to North America, to Latin America, everyone has different agenda, different interests. Unless you find a way to sort of modify this debate or this argument, you're never going to get agreement on a policy that works.
Maynard, if I could just jump in here, I can't resist. Bob, I loved your comments and wholeheartedly agree with them. Africa using 1 barrel per capita versus 10 in Europe and 20 here, but they can't have a singular pipeline from, Uganda to Tanzania. This is just pure insanity. I'm curious though, as you all think about your investing, do you all do you have a macro perspective that says we believe oil demand will grow or flatten out or not fall off a cliff? Or I realize the asset is most important, the opportunities are most important, but how does some broader macro perspective fit into how you think about investing in this space?
The way I think of it is very high level. We're going to need fossil fuels for a long time to come. Someone has to own this stuff. It should be a responsible rather than irresponsible owner, an accountable owner rather than an unaccountable owner. So those are what you're trying to do. The next thing I think that we can afford to do as a private equity player is make the argument that we will, as we did in Gabon, keep an existing flywheel spinning. We don't need to start new flywheels spinning. And if you're worried about sort of launching, a new basin where you embed or sort of get capital or value buried in the ground that people see as driving these mismatches in policy because now the owner of that asset wants to produce it no matter what. We don't do that. We don't have to do that. But if we keep the existing flywheels spinning and can make them work better, that's all we have to do. And I think that's a pretty good policy macro for us to have.
Yeah, and the only thing I would add, Arjun, is when we go into these upstream deals, we hedge our downside, right? So we try to buy into conventional producing assets that break even at, call it $30 a barrel plus minus, and we try to hedge around $50 to $60, and we'll sort of ensure our capital structures are flexible to pay out dividends as we go, so we're not dependent upon a single point exit, but kind of a series of cash flows at potentially different oil prices. And so that kind of mitigates some of the longer term macro risk, I guess, because it's really kind of a year-to-year view on the cash flow and managing a business within a sensible financial framework.
So guys, one question. So I mentioned it up front. You have 2 funds, almost $5 billion. You've deployed it successfully. You've had some great exits. What do you feel about or sense? Is there more capital that wants to do this? Like, what is your sense of institutions' willingness to do more of this type of activity?
Well, I'll start there. I mean, our big observation on the capital base here is, 3 to 4 years ago, we were at peak divestment in oil and gas and energy, traditional energy. That perspective has shifted considerably, particularly after the war, where the consensus seems to be emerging that the energy transition needs to be more inclusive. You need all forms of energy. You got to produce energy as clean as you can, as cheap as you can, but you kind of need everything. And so that for us is a potential opening of capital as we look forward, because if you can, create a series of traditional energy investments that are investable for a broader set of investors, because we do put them onto we put assets onto transition pathways that are appropriate for those assets, then that's an interesting story, because energy is still trading at a 60% discount to the S&P. It's still cheap, and it's generating great cash. So the key is to make that investable for a broader group of investors, and much of that comes from positioning these assets in their right place for transition. So
is it fair to say maybe the investor pool is getting a little bit bigger? I mean, I know it's not rapidly, or is it the same, or we're watching it closely?
But I just go back to your starting point, which is, we have two funds, basically $5 billion total. But if you mark that to market, the AUM is probably more like $8 billion. But if you then look at the equity, the gross equity in our portfolio, it's $24 billion. Because, by which I mean we've brought in partners like Mubadala, Incepsa, or CIC, or CVC. But so the ability to aggregate capital is much greater than the fund size that we're talking about. So we're 24 billion of equity, which I think, speaks to, first of all, the scale that you could go after, that's available to go after. And I don't see that changing. Like we said, it's better to be big than small. So the more of that you can, accumulate and deploy, I think, the better.
You guys are in London, that's home. What would you say is happening? I know it's kind of hard to generalize across the whole continent, but I think we're wondering here how attitudes are changing in Europe a little bit, how we're going back into winter here pretty soon. I think we're all kind of waking up to you can't decarbonize by deindustrializing. That's not a good answer. What would you tell us about the pulse of Europe and energy policy, and kind of, is it staying? Also, you see all this just stop oil stuff. It seems like, there's some behavior that's really odd right now, but how would you summarize the way attitudes may or may not be changing? And I know it's a really hard question, but
I think very high level, the inconsistencies are becoming apparent. People are getting it, that it's not just one thing. Policy-wise, it's confused, it's hesitant, it's sort of kind of wounded now because of the experience. And the comeback, like you see, the UK sort of now committing to have new exploration rounds, new license rounds. At the same time, as the banks in the UK are not going to support any of that. So you have a policy which recognizes the need for energy, but a social system now that's been geared to not support energy. And that has to sort of reconcile. But it's just going to be a period of uncertainty, hesitation, confusion, I think, in the market. And, that's where it is.
Well, we were with an executive today who told us, I would absolutely look at the North Sea, but my problem is, at the same time, they might be more encouraging. They're also saying excess profits, like, I'm going to take your profits, so I'm not going to go there.
All of Europe, not just the UK, all of Europe is, this time, because you're making surplus profits, we're going to take some of it back, but that'll only be for a little while. Well, the longer it lasts, the longer they like it, the stays. You can't be sure. It's a very changing landscape. In contrast, I'm pretty sure the PSC terms in Egypt haven't changed since 1954, or in Libya since 1958. Now, which is a more unstable regime? I mean, it means Europe is becoming increasingly risky. The rest of the world relatively is becoming less. Gabon looks pretty good compared to the UK.
Yeah, one of the things that kind of sparked off this question is back to the ENI sale. I mean, one of the reasons that you mentioned for them doing it is just to lower their carbon emissions internally. And I think about the oil majors, say, over the last 12 to 18 months. I mean, there were some big divestiture targets out there. They've come in a little bit, but I start thinking about, even getting your emissions lower is a goal, how many properties are going to come out in the market now that are just very high emission type, packages that really kind of play to your strengths, where you can pick these things up cheap and go and do like you did and say, okay, we're going to put a battery here and do this. We'll get the emissions lower. We'll go ahead and take that risk because the price is low. Is that a big market of packages that are potentially out there? Or is that a strategy for you guys?
I think it's the kind of thing that we are picking up in conversations with bankers and other counterparties. And it's not just lowering the emissions. It's just thinking more holistically about upstream and transition, right? So it's, can you buy some well bores for sequestration? Can you buy some midstream infrastructure for sequestration? I mean, the other piece of Neptune that appealed to E&I was the carbon sequestration opportunity offshore Holland, which is an area, it's the most mature area in that portfolio. We had to make a decision a few years ago to either decommission that or do something else. And we said, well, this is prime acreage for sequestration because it's very close to the shore. The emitters are there. They're paying a European carbon price already. We own the midstream infrastructure, the platforms. And so we're building a business around that that is very competitive with the European carbon price. So there's a number of ways to kind of play that thesis, actually, but it requires just a different mindset, right? I mean, it's just another kind of value creation lever in addition to production enhancement and cost takeout.
Wanted to come back to this issue of, there's these various net zero alliances, and you just referenced it, I think, Bob and Par, where a lot of pressure on European insurers and capital markets providers, as well as U.S. Equivalents, to not finance oil and gas or not finance it in what they'll call Arctic, which apparently only includes Alaska for some reason, but all of Alaska and so on and so forth. We already referenced the Uganda-Tanzania pipeline. I mean, I think on the one hand, this presents a tremendous opportunity for folks like yourself who have, ability to raise capital, have strong financial backing, and can go into some of these areas. But you still have operating companies who might need insurance, who need banks and so forth. Do you see, is this a risk? Is it an opportunity? Is it something we should worry about in the future, but really is overstated as a concern today? I'm curious how any of these sort of pressures, and I'm not talking about ESG, I'm talking specifically about the net zero alliances that are focused on insurance and capital markets, how you see that as an opportunity or threat for what you are doing.
I'll start on that one, Arj. I mean, I do think it is a threat to the upstream businesses because it's becoming, an increasingly dwindling pool of banks that are able to underwrite RBLs for traditional upstream deals. I mean, whether you've got carbon sequestration or not, it is an issue. Where it's an opportunity is on the downstream side. So we own two large European downstream businesses, Cepsa and Varo. These are both traditional fossil refineries and storage and midstream infrastructure. But we're investing, about $10 billion across those two businesses to turn over the EBITDA from 100% fossil to majority renewable through initiatives like HVO and green hydrogen, EV charging, et cetera. Those footprints are natural places to kind of build out those new businesses, extend the duration of those business lines. But there are banks that are willing to kind of come into that kind of capital structure and really get behind it. And so that gray to green idea is really interesting. And we think there's a lot of running room there. So hopefully that kind of offsets some of the headwinds on the upstream side.
When I think about these countries ultimately wanting to have self-determination, to not wanting to be dependent on Europe for sure, but perhaps not even the United States, it strikes me that, I'm going to simplify here, China is a country that is well positioned to kind of finance itself and go on its own. And I suspect India, if it's not there, is pretty close to there for all practical purposes. The region that I believe may not be there is the continent of Africa. It's 54 different countries. That's too much to talk about each of them individually. But in aggregate, I feel like Africa is still more dependent on especially European and perhaps US institutions. Is that all a fair assumption? And again, is there an opportunity for alternative capital providers? Maybe they're in the Middle East. Clearly, private equity has a role to play to kind of fill that gap that's going to probably exist from the traditional, especially European, but maybe even US banks and insurance companies.
I think we have seen more local banking develop in areas like Africa and the Middle East, Southeast Asia. So, there are pools of capital that will fill the gap. It's just going to be a different type of deal. And then, of course, there's, kind of non-traditional financing sources. So the commodity traders are increasingly involved in capital structures, getting flows to the commodity as well. And so it just requires a bit more creativity to cobble together financing in places like that. But the opportunity is still there. I mean, the assets are still there and they're cash flowing. So the capital sort of will find a way.
But for instance, we renegotiated our RBL in Gabon not long ago. We've got more banks than we originally had come into it. So.
And are those, Bob, you don't have to name names, but are those banks, quote, exotic or more like Western banks? Or what would you say about the names?
I wouldn't say they're
up?
exotic, but they're not bulge bracket either. But they're regional banks, they're local banks.
Yeah, we had the same experience in Colombia with our business there. Just upsized the revolving credit facility with local banking relationships.
So, guys, it's hard to wrap up because there's so much we could talk about. I think one thing I was struck by in if you think back to what we were talking about in the beginning, which is the old days when you went international, because that's where the big stuff was to be found, that also often meant offshore a lot of times. And then there was also a feeling of like, well, if I'm offshore, I'll have an account that kind of protects me from political risk. There was various reasons why international was often synonymous with offshore. You guys are onshore Gabon, onshore Colombia, onshore in some of the Neptune portfolio. A lot of the U.S. players are obviously onshore guys. Do you see, and you mentioned short cycle, Bob, for all the obvious reasons, do you see onshore opportunity? Should a player who has that skill set think that there could be really interesting potential short cycle onshore opportunities international?
Yes, I think so. I mean, are they sort of a dime a dozen? No. You have to look for the right ones, but I think they are there. Again, you have to have conviction that you're able to deal with the above ground risk, which starts with your, as I said, the non-replicable sort of asset, which is your team or your background or your history or your network or whatever it is that gives you that confidence. But I'd say that's the most important thing. They're there, but you have to be willing to deal with the above ground risk.
And I would just add to that. I mean, I think the temptation to kind of do international from a general pocket, a U.S. focused pocket is very strong because it looks like it's there and it's appealing. It's maybe undervalued, but it really does require conviction and investment to get right. And the only reason that's worked for us, one of the only reasons it's worked for us, is we've got 17 people in London where all we do is international energy, and we've got a dedicated pool of capital for that. So it doesn't kind of get competed away because there's a home bias in, say, the U.S. or another market. That's important because to Bob's point about the non-replicable footprint in the team. That is what creates the conviction, and that actually creates the deal. Otherwise, it's not something you can do as a hobby or in kind of a generalist way.
Very interesting. Bob, we got to wrap up with this one, particularly for you. We're always talking about 10 years from now. What does energy look like? When we get you to come back on the show in 10 years, what do you think we're talking about? Big picture, issues, opportunities. Like, what's the energy world that we'd be zeroing in on in 10 years?
I think it will be much more about, progress on decarbonization, continued involvement in presence of fossil fuels in the mix. It will be there, but our sort of ability to deal with them, our ability to decarbonize, our ability to tolerate them, I think what will have changed because it has to change. And I believe that there is going to be ingenuity, there is going to be creativity in the system. It will be around that because we have to make it work. We have to make it tolerable because it's too embedded in the system. We can't get it out. Certainly not in 10 years.
So we will have, quote, improved, but it'll just be a more realistic conversation.
Yes, but it will be on I think, a more realistic trajectory toward eventually a solution or a long-term kind of accommodation to all of this, to what we need, what the world deserves, what the world that's outside, the developing world deserves, what we've had, and how do we reconcile all of that? It's not going to be easy. I mean, it just isn't.
Well, Bob, thank you so much. Par, thank you so much. We got really lucky you guys were in Houston and we talked them into joining us for the discussion. So thank you so much,
Pleasure.
guys. And thank you, everybody. We appreciate you.